Hello and welcome to the Monday Technical Market Outlook for November 24th, 2008. This is your host, Patrick Ceresna. As always, we start with a weekly chart of the S&P 500 going back 2 decades. And even if we go back 4 decades and plot an 80-week moving average on the index, it has been a very good depictor of every bull and bear market cycle that the market has gone through. In January of 2008, we crossed below there, and that's when we started our thesis or theme that we are in a bear market that should last many months, if not more than a year in total duration. And at this stage, it appears that it will be more than a year in total duration, most likely lasting into the middle of next year, but we'll call that more accurately as the time comes closer. When we take a closer look at the S&P 500 using the exchange traded fund spiders, SPY, we were last week talking about that any technical breakdown below that 84-85 level would immediately open the window for a much sharper and deeper decline. We now adjusted slightly our focal point on below that at the 77 and 79 zone, which at this stage represents the 2002 and 2003 lows. And this is a very important level for the market to maintain, because any significant break below that level sort of opens the window for much deeper declines, which initially would be targeting down to 68.70 on the downside, but can actually go to a few lower targets below that as well. So at this stage it's vital that the market digs in and holds in this point. Any rally that we get that fails at this 84-85 area immediately will lead to probably another wave of aggressive selling. So the only thing that the bulls can really do and hope for at this stage is that any robust rally that gets the market back above that 85 level to neutralize the bear momentum. At that moment we can start seeing whether we have a loss of momentum, market bottom, and then whether there's a potential for reversal. But at this stage it's very important to respect the fact that the momentum is with the bears, and we now need to see some sort of price action follow through on the upside in order to give the bulls any chance here. Just to review our key points, our thesis since January 2008 has been that we're in a bear market that should last many months, if not more than a year, and we're certainly more than likely going to see at least another 6 months of price action before we get a clear bullish signal that a new bull market has started. The market broke below this 84 level on those spiders, and at this stage it's signaling a continuation of the bear market, so we need to see new bottoms come in place and see that holding. The key thing I want to just mention is that after Friday's end of day reversal, we are now watching for follow through. The trend has been and is to sell failed rallies, and so at this stage it's not enough to see price action holding on Monday's open. We really need to see a strong, robust rally with some conviction, because if there's any stalling or tapering, the sellers will come back in and take that market to a whole new level. So it's vital that we see some sort of buying conviction come out first thing Monday. The last thing we just want to always emphasize, and we've been doing this for the last 11 months now, longer term investors need to be very cautious. Avoid overexposure to the markets, and only short-term actively managed trades are prudent. Next here we're going to look at the Canadian XIU, which is the S&P TSX 60 exchange traded fund. And last week we were emphasizing over and over again about how important it was for that market to hold that 1350 area. The moment that area broke on Wednesday, it immediately opened the window for a more robust sell-off to the downside. We came right into our technical target zone of 1175 to 12. It's so vital at this stage for the bulls to try to have some sort of a follow through back above that 13.5. Any failed rallies here below the 13.5 area immediately keeps the window wide open for a move all the way down to 10.5, 11 on the downside. The only way the bulls can actually neutralize this bear momentum is to get back above 13.5. So let's see what they can do this week. Next here we're going to look at the US dollar index, and we've now had a technical close on Friday above the $88 focal point, and at this stage the window is open for a more robust rally in the US dollar, which could see us coming up testing the 89.50 to 90.50 area later this week, but there is lots of room for even further upside, and some of the basic technical measurements can point all the way up into the 92.5 and even the 95 area area on the upside. Any technical reversal back below the 87, 88 level, we would then be looking for a further pullback. But so long as it continues to consolidate above here, we're looking for higher markets here. Next here we're going to look at crude oil using the Crude Oil Exchange Traded Fund USO, and this one here was finding some technical support in the 43-46 area earlier in the week, but a technical break of that area has now got it trading at much lower levels. The technical weakness continues to be pretty poor here, and like our forecast, we continue to anticipate weakness, and at this stage targeting down into the 30-35 area is quite realistic on the downside. Any technical reversals off of here, we need to have a rally that gets back above the 43-46 area and a bottoming formation to start anticipating a new trend in oil. Next here I want to take a look at gold using GLD, Exchange Traded Fund of Gold Bullion, and we had a very strong technical breakout on Friday in spite of the strength in the US dollar, so gold is really bucking its natural trend here and with a very strong technical break. At this stage, one day does not make a new trend, so immediately what I just want to put a little bit of caution. What we really need to see is some follow through and not immediate strong selling. So what we see on Monday and Tuesday will be very important to give us new conviction as to whether we may be starting a new uptrend in gold. First of all, it would be very bullish for oil price action to be contained above the 76, 77 level. At this stage, the immediate area which we want to watch is the 80, 82.5 area on the upside. If for whatever reason this rally fails in that area, we may be looking at another round of selling to come from that zone. For us to really be big picture bullish, we want to see a rally that holds above 82.5. At that stage, we can then start looking for something that may be happening different in a big picture perspective. Finally, we want to have a look at the Canadian dollar using the ISC Canadian Dollar Index, symbol CDD. And as you can see, the Canadian dollar initially last week was stalling below that 24.25 focal point. On Wednesday, with a technical break above it, led to a robust rally that came testing right into that 129, 130 focal point above. At this stage, on Friday, we saw a little bit of give back, but a lot of this will have a play on the US dollar index, in a sense that if we have any technical break above that 130 level, a much more robust US dollar rally will most likely occur. So it's very important for us to watch these technical levels and to see whether this ends up being a topping formation here or whether we're going to higher levels. Thank you for joining us for our Technical Monday Market Outlook for November 24th, 2008, and look forward to seeing you online next week. Thank you.